All right, day 466. Today, we're staying consistent. We're looking at properties to add to our comparable sales list. And if you've been following what we've been doing for the past 12 months, we've been adding to this list of properties in the Birmingham, Alabama market by zip code and obviously capturing the right amount of details there, right? Bed, bath, square footage, year built, the lot size, price per square foot based on the prices, and also the lot size, as well as what subdivision they're in, and some general condition notes about the home, especially around the kitchen, bathrooms, some things that typically appeal to your typical home buyer, right? Now, the reason we're doing this is because, well, we've been tracking all these properties that have been sold in the last 12 months. Then we started tracking properties after that sold in the last 3 months. Then we've been tracking properties that are coming onto the market every single month, and the reason we're doing this is because of the BRRRR strategy. Okay. Now, what is the BRRRR strategy? The BRRRR strategy stands for buy, rehab, rent, refinance, and repeat. And when you are pursuing the strategy, one of the most critical components of underwriting that deal is estimating the ARV, the after repair value. And the reason is this, right? Let's use an example. If you bought a property for 20 grand and you spend $50,000 renovating that home, but now all of a sudden you're on a 70 grand, but you're able to make the home worth $100,000. You just increase the ceiling of your property and the valuation. Now what you can do is you can go get a 70% loan to value LTV DSCR loan. And that allows you to take back out that capital that you originally invested and use that for your next deal, right? You get back out that 70 grand in the form of loan proceeds. So it's not taxable. And now all of a sudden you can go and figure out what you're going to do with the 70 grand that you just pull back out. You can rinse and repeat and use that to buy another home for 40 grand. Maybe that costs $30,000 to renovate. But that allows you to scale up very fast because you get to take the same 70 grand, the same $70,000 of capital that you originally invested and use it over and over and over again, right? That's the beauty of the strategy. Because what's the alternative? I mean, you could be saving up from your full-time job for the 20% down over and over and over again. And that's a really slow process. Not saying you can't be successful doing that, but it's a slower process. So to each their own, you have to figure out what your strategy is. All right. Now, getting the ARV correct is heavily dependent on the market conditions, right? Because homes and home prices fluctuate every single day. Now, if you are following the 30-year mortgage interest rates, you'll notice that it's really affected by a couple of things. All right, look at this. Right now, the 10-year treasury yield interest rate is roughly around 4.7%. And if you look at the 12 months, this is nearly at its peak. You see that it's been as low as about 3.6-ish, 3.3-ish. But it's really driven by two things. One is the interest rate of the 10-year yield, the 30-year mortgage interest rates, and the spread between the 10-year yield and the 30-year mortgage interest rates. As the spread narrows, that drives down your interest rate. Historically, that's been about 1.5% to 2%, but it's gone as high as 3%. That's why you saw interest rates at around 8% at one point. It's crazy. But now that the spread is narrowed, that's why you don't see interest rates in the eights. You might see it back closer to sevens because of what's happening in the market. So these factors are going to be so important for you to consider, right? So now, as you go into your properties, that's why we are looking at properties that are coming on the market so that we can keep a pulse on what's happening in the market every single month. All right. So for this property, this is in Center Point. This has been on the property for 3 days, and just show you what I'm filtered on. I'm looking at properties that are 4-bedroom plus, and because I'm generally looking for 3-bedroom homes that can convert to a 4-bedroom for additional rent, but also increase in value so that I can increase the chances of me pulling out as much capital as possible so that I can rinse and repeat the same pile of cash that we talked about earlier. Now, that's how I found this property in Center Point. Center Point is a quieter area outside of Birmingham. It's about northwest of Birmingham, but you can see this area. Let's see. What's an ideal comp, right? Ideal comp is if this property right next to it had the same bed bath count, same square footage, same lot size, same year build, same finishes. That would be ideal comp, but that's usually never the case, right? Because as you go across man-made borders, such as these main parkways or creeks, mountains, or highways, the risk of that ARV being incorrect goes higher, right? That's just the natural truth, because you're never going to get a perfect comp unless you really do get lucky and you find a so comp within the last month within right next to your home. Generally doesn't happen. But if you get an A loan and you get an appraised value lower than what you wanted, how are you going to challenge that property? How are you going to challenge that valuation? You have to provide comparable sales from properties in your market of a similar nature. And this is why we're tracking all these properties, because, hey, what if you thought this home was going to be worth 250 grand? But now all of a sudden, because of interest rates going up, you see that homes are coming onto the market for lower value. And if they get sold for that lower valuation, then you might be in trouble because you might not be able to get back out all your capital. Now, could that still be new? Yeah, but it won't be a perfect BRRRR, quote unquote, where you get back out all your capital. All right. So on this property, this property looks pretty good. I mean, it's recessed lighting, all new floors, all new painting, some carpet. So you could remove that you want, but bathrooms are great and outside is great. Kitchen looks great. Okay. Above average. Okay. So now I'm going to write down these details because I want to be able to reference this property in the future when the time comes. All right. So this is a 4-bed, 1.5 bath. 1387 is perfect because usually I see homes around 1,300 square feet. And this property was built in 1969. $215,000. So on a dollar per square foot perspective, it is $155. Listed 3 days ago, so it was listed 1,525.3 acres. Okay, great. Now let's see what neighborhood this is closest to Brittlewood. Okay, Brittlewood. All right, one of them. So I'm going to write this one down so that I can quickly understand what's happening here. All right. Recessed lighting, new flooring, some carpeting needs to be removed. Above average kitchen and bathrooms, no renovation needed. Okay, so now I understand the condition of this home. And is there any garage on this property? Oh, there's a garage. Great. Yes. No basement, no HOA. So now if I ever find a 3-bedroom property and I'm looking to BRRRR that property, I can now refer back to this property and say, hey, what did this property sell for? How much can I reasonably expect the after repair value for my home to be worth when that time comes? All these factors matter. So just be really, really conscious about that fact. All right. So now what I'm going to do next is I'm going to figure out one. What is this property going to be worth? So what I'm going to do next is I'm going to analyze this property as is. And I'm going to go and plug in some of these details there. So this property is $215,000, right? Now that I got that detail, let's just analyze this deal together, right? For the rehab on this property, I will probably set aside $1,500 for the roof just in case there's any issues, $500 for some landscaping. I will not have to paint any home. There's one room I could probably change to LVP, so I'll probably put 300 square foot there for new flooring. Don't need new appliances. That seems ready to go. Don't need to repaint the cabinets. The bathroom look great. I will still have 2 toilets where I will replace the toilets with high pressure flush toilets so I can avoid any issues with clogged toilets. Because if you get the high pressure assisted toilets, I mean, they only cost like $450. If you ever get a clogged toilet call, I mean, that'll probably cost you $200 to get the plumber out there. Maybe you replace the toilet afterwards for another $200. That's already $400. I say just get it replaced because I have these at my other rental properties and I've never had to call toilet call before. So I'm super happy about that. And don't underestimate the time and the energy it will cost you to take care of those problems when they come up. It's just not worth it. Take care of it up front so that you can avoid all these issues because that's the only way you'd be profitable. Well, not the only way, but it will not make you feel like you are drained of energy. All right. So $63,000. Let me delete this plus 10,000 in B6 because that was from yesterday's scenario. And now for my rents, I'm going to go to affordablehousing.com and I'm going to plug in the address in the owner section under the market rent estimator. I'm going to plug in the address, plug in the bedroom count, and I can see that on average, the rent for a 4-bedroom home here is roughly around $1,400 for 25 units within a 1.68 mile radius. $1,400. Great. Let me put that in. That seems pretty reasonable. And my property tax estimate on this property from the payment calculator is $58. Let me put that in. That seems a little light, to be honest. And my homeowner insurance is $167. So I'll do equals 167 times 1.2. Now, for the county assessor records, obviously double check with your property tax amount with the county assessor to get the exact calculation before you close. And your insurance, I mean, you should always get a quote from insurance broker. But right now, all I'm doing is figuring out whether or not this property is worth my time. And I'm doing that by just using rough estimates because this 167, I'm assuming, is an insurance estimate for a primary residence property. And if I'm using this property as an investment property, well, generally that means that it's going to be a riskier asset in the eyes of insurer. So that's why I'm adding a 20% premium here by multiplying by 1.2 because I want to be conservative. Then I'm setting aside 10% of my rents every single month for maintenance. And again, I'm doing this because, well, I want to figure out whether or not this property is going to cash flow with expenses that I know are coming my way, right? I know that the roof is going to get replaced in 10, 15, 20 years. I know the HVAC is going to get replaced. I know that a water heater is going to get replaced at some point, right? I just got a bill for $15,000 to replace a roof on one of our Scottsdale homes. And guess what? If I didn't set aside $150 every single month for 100 months, then I would have been overestimating my profitability, thinking I made all this extra money, when it could be because I underestimated my expenses. When in reality, I should have accounted for that number. So don't be like me. Make sure you set aside that money and learn from those lessons. And don't ever believe anyone that tells you that there is no maintenance. That's how you know that they're a sham. Every property has maintenance. Every property has items that will get replaced. It's just the nature of your home. Even your primary residence home, you're going to have to replace some things, right? All right, then I got 10% set aside for property management expenses, and I got 5% set aside for vacancy expenses. Vacancy just simply means someone's going to move out of your home, and there's going to be days where it's empty, right? There's going to be things that matter. There's going to be things that come up, right? I've had inspections that were missed simply because they got the address wrong. They confirmed in the wrong city. It's silly, but it happens. Just understand how to account for that and include that in your numbers and be conservative. All right. Then in F19, I got 25% down from this property. And then my down payment amount in E19 is going to be equals to my asking price of $215,000 times my 25% down payment in F19. So I'll be putting down $53,000 on this deal. All right. At 7.5% interest rate, my financing amount is going to be equals to my B4, my asking price, minus my down payment percentage. That's $161,000. So if that is the case and I got 2.5% for closing costs, I would be on this deal. If I rented out as a 4-bedroom for $1,400 a month, I will be losing $336 a month. That's a negative 6.2% return. Assuming I bought this product for $615,000 with a $6,400 rehab, 25% down, 7.5% interest rate. Now, that's obviously not a deal, right? I mean, I don't know about you, but I don't want to lose money every single month. But this is not investment advice. I'm not soliciting any investments on this call. I'm just showing you all how to adjust the factors and the inputs on the spreadsheet so that allows you to figure out, hey, how do I actually analyze this deal without my emotions getting involved? Okay. Now, if I lower my asking price, watch what happens to the cash and cash return. If I lower this to $100,000, now all of a sudden I'm at 9.5. So maybe at $98,000, I'm at 10%. Great. Again, not saying 10% is a magical number. Just showing you all what I'm doing, because you have to figure out what is your target return that you're looking for. And ultimately, why are you pursuing that number? So at 98 grand, assuming everything else stays constant with a rehab of 6,400 at 25% down and 7.5% interest rate, that allows me to achieve the target return because you have to justify the execution risk for yourself. Right? Is your contractor going to show up and do what he or she said they're going to do? Is your property manager going to come through? Is your tenant not going to trash your home? You have to justify to yourself, why is it worth that? Because some people might just buy $1 million homes, and thoughts and prayers are with the folks in LA. I mean, some folks might be buying homes in Southern California for $1 million. If they can just break even on that deal, well, what does that mean? If you can just break even on that deal, they say I can make 5% appreciation on $1 million property. That's 50 grand a year. They might not even care about $200, $300 a month of cash flow a month because they're building wealth a completely different way. But that's very speculative. That's very risky, right? So to each their own, you got to understand what your strategy is, why you diversify your portfolio a certain way, because all that stuff matters, all right? So the next factor here is I want to talk about one, what happens if my renovation double? What if it doubled? You multiply by that 2, now all of a sudden your rehab is 13 grand. You saw that your cash on cash return number went down. So you bought this property with inspection and you realize something's wrong, right? Well, all of a sudden, now your cash on cash return is 8.4. So now you might only be willing to afford 90 grand for this deal instead of 98. And that's with you doubling the rehab to about, call it 13 grand, a 7.5% interest rate. That'll still get you to a 10.2% return, right? Now your cash flow $320 a month, assuming you still rent it out as a bedroom for $1,400. Now, one more scenario. If your interest rate lowers to 6%, so it drops by 1.5 points, look what happens, right? Even though my rehab doubled, my cash and cash return number jumped because of the interest rate. So now you can adjust up and downwards your deal to here, to $98,000, okay? All right, so now you're still at 10%. So maybe you can go up to 100 grand. Whoops. Right, so now you can go from 6% to 10.2. And that allows you to figure out what's happening next. All right. So with that said, you can achieve a 10.2% return with a 6% interest rate at $100,000. So you can see what has happened with the scenario, right? And just adjust up and downwards all these factors as you go about all these properties, right? So I hope this was helpful, everybody. My hope is that you copy my homework, right? Analyze the same deal I analyzed today using the same spreadsheet. You guys want to copy the spreadsheet, just go to affordablehousing.io, go to the Get Deal Analysis tool, plug in your name, your email, phone number. That's the fastest way for you to copy the spreadsheet. And my goal is for you to start your own YouTube channel. Because when someone asks you, hey, why do you think this is a deal? You can say, hey, I've been looking at properties for the past 466 days in a row. Might that give you some confidence that you know what you're doing? I certainly hope so. All right. I hope you all have an amazing Wednesday. Spend some quality time with your family and friends today, because that's what life is all about. Thank you so much for caring about affordable housing, because without people like you, I would never have the home I grew up in. I'm so grateful for you all. Stay safe out there, especially in Southern California, especially in LA. Stay safe out there. I'll see you all tomorrow for day 467. Have a good one, everybody.